All right, hi guys, good afternoon. So today we're going to talk about options. Okay, we're going to talk about options. Now, just to kind of circle back on yesterday's topic. Okay, so when we talk about forwards and futures, in this, there's a term that I wanted to. We already spoke about it, but what you guys need to understand is that in forwards and futures, both parties, and I say both parties, both buyer and seller, have an obligation. Okay. Now, what does the word obligation mean? Can anybody tell me? Okay, you have to do any which way, right? So we'll term
Responsibility,
as no choice. Okay.
no
So,
choice. Yeah.
for example, you have an obligation to study. I don't know. I mean, in my mind, you have an obligation to study, but we'll see what happens. Okay. So, when we talk about derivatives, these terminologies are very important, and it's also important that you need to know when to use them. Okay. So, when you talk about forwards and futures, both parties, okay, when I say both parties, both the buyer and seller have an obligation. And what does obligation mean? No choice. Okay. Now let's look at the term options. Now, generally, when we look at the word option, what does it mean? What does the word option mean?
We have alternatives. We
Okay,
have
you have an
different
alternative, you have a choice. Okay.
choice. Yeah. Yeah.
Yeah. So when we look at options, right now, as a general English word, options means you have a choice. Okay. Now, if we apply the word options to, the financial markets and to derivatives specifically, right? It means a lot of things. Okay, it has a lot of information to it. Okay, now how do we define an option? Is that option is a derivative contract, so we're still talking about derivatives that gives the buyer, okay, that gives the buyer the right to buy or sell the underlying asset. All right, and the seller has an obligation to the buyer. Okay, so let's look at this definition here. Now, a couple of the key words that I'm going to highlight. Okay, so the word right and the word obligation. Okay. Now, what does the word right generally mean? And we just talked about it. It means choice. Okay. Now, when we talk about choice, basically what we're saying is the buyer of the option contract has the choice. So, again, the word choice I'm using to buy or sell the underlying asset. Okay. So that's what we mean by the word right. Okay, right means choice. Okay, uh, and the word right, when we talk about even what is it like? Let's say what is it? Right to freedom, right to education, etc. Right? Basically, and is all of that an obligation or is it a right? So, for example, in the Constitution, it says right to free speech. Now, what does that right mean? You have a choice to speak freely, but it happening, not happening is a separate thing altogether, right? But the word choice basically, the word right means it's a choice. Okay. Now, when we apply that to an option contract, it means that you have the choice to buy or sell the underlying asset. Okay. So please remember, we're talking about derivatives again. So we have the underlying asset. Okay, so let's say this box is the underlying asset. Okay, the box is the underlying asset. And what happens? The derivative, for example, options, right, sit on top of the underlying asset. So that's why we call this as the underlying asset. Okay. Is this definition clear to everyone? Okay, let me explain again. Please understand what I'm saying. So again, options is a derivative contract. It gives the buyer. Now another key word here is buyer. Okay, and we'll talk more about this. What does the buyer do? What does the seller do, etc. Okay, So the buyer has the right to buy or sell the underlying asset. Okay. And the seller of the option has an obligation towards the buyer. Now, what does the word right mean? Choice. And the word choice means they basically have the choice to buy or sell the underlying asset. And obligation means no choice. Okay. The seller has no choice to buy or sell the underlying asset. Okay. Is this clear? And anyway, we will go more in depth and understand these words and its meanings. But are we clear with the basic understanding of what is options in terms of a definition, and what does the word right and obligation mean? Okay, cool. Okay, quickly write this down and then we'll move on to the different types of options. Everyone done? Okay, are we clear with the definition, guys? Yeah. See, practical is, yeah, we'll get to it, but you gotta understand that you need to understand the terminologies and all that. That's equally important. Okay. So again, to reiterate, in forwards and futures, you have an obligation. Okay, that means both parties must honor the contract. Okay, whereas in options, one person has the choice to honor the contract. Okay, I mean, they can choose to honor the contract or not honor the contract, but the person who is selling them the contract has no choice but to honor the contract. Okay, anyway, we'll talk more about this. Okay, so now let's look at the different types of options. Okay, now when we look at options, all options should always, always be looked from a buyer's perspective. Okay, should always be looked from a buyer's perspective. Again, I'll come to why and all of that. Okay. Now, the first option that we'll look at is what we call as a call option. Okay. Now, call options are used when you as a investor, trader, whatever you want to call yourself, okay, when you are bullish about either the index or a stock, okay, you're bullish. Now, what does bullish mean? It means that you're expecting the price to go up. Okay, you're expecting the price to go up. Okay, now when you look at call options, okay, call options are subdivided. Okay, they are subdivided into what we call as a long call option contract and a short call option contract. Okay, now if you guys are not aware, the term long means to buy and short means to sell. Now, the person who is a long call option contract, okay, they're bullish on the stock or the index, and the other person is bearish on the stock or the index. Okay, now again, you guys have to understand when we, like I mentioned, right? It's about two sides of the same coin. Okay, so call option is your first coin. Now, on both sides of the call option coin, you have a long call and a short call. Okay, so and you have to understand again is that the market cannot be that everybody is 100% of the market is only bullish where and 0% is bearish. That cannot work. Okay, and also vice versa, 100% cannot be bearish, okay, and zero people are bullish. So the entire market is 50-50. So 50% of the market thinks that the asset is going up or going down, and the other 50% is thinking about it in the other way. Okay, so in long call, if I'm a long call option holder, so you will be a short call. Yeah, so long call, if I'm long call, you have to be short call. Okay, so there always has to be two different points of view. Okay, there has to, one person has to think up, the other person has to think down. Yeah. Yes, sir, exactly. So when you talk about bearish, you're expecting the price to go down. Hang on, price to go down, and bullish, you're expecting the price to go up. All right. Is this clear with everyone? Yeah. Okay. Now let's look at the rules. Okay, and you guys have to really, really pay attention to everything that I'm saying here. Okay. And it's, you will not initially get it. You have to practice this for a couple of weeks, then only you'll understand these rules. Okay, so now let's look at the rules for long call option contract. Okay, so what is the first rule? Okay, is that in order, first you have to decide whether you're going to buy the option contract or not. Okay, so the first rule is you're going to buy a call option contract. Okay, now how are you going to buy it? You have to pay a premium. Now, what is premium? Basically, money. You have to pay money to enter into the contract. Okay, now because you have paid a premium, okay, you have the right. Okay, now what does the word right mean? It means choice. Okay, and now what is your choice? Specifically to buy the underlying asset. Okay, and you are known as the holder of the contract. Okay, these are the first four rules of a long call option contract. Okay, all right. Now, any questions on this?
Can you please explain again the last 4 points?
Yeah, sure. Yes, Saurabh. So you think of premium as what you pay to enter into the contract. Okay, I'll explain it again. And again, we have to do examples, then only you guys are going to understand this. Okay, so but we have to go through the theory first. Okay, so let's look at these four top points again. Okay, so in order to enter into a option contract, first you need to buy the option contract. Now, how are you going to buy it? You have to pay a premium. You see, think about it this way. In order to enter into a futures contract, what do you have to pay?
Initial margin.
Exactly. You have to pay an initial margin, okay? But in options, margins don't exist. I mean, on the long side, on the buy side, margins don't exist, okay? So rather, what you have to pay a premium. You have to pay a certain amount of money to enter into an option contract, okay? Now, because you have paid money, you have the right or the choice to buy the underlying asset, and you're known as the holder of the contract, okay? Is this clear with everyone? The first 4 points? Okay, don't worry. We'll again have to do examples for each of it and all of that. So we'll have a lot of what uh, you'll have a big headache by the end of the class. Okay, I promise. That's my goal, to make you guys think. Okay, all right. Now let's look at the other side of the coin. Let's look at what's happening on the short side. No, so Preeti, we'll come to that later. But to answer your question, yes, you'll have to pay extra. Okay, we'll come to all those things in a bit. Okay, all right. Now let's look at the short call option contract. Okay, now what's going to happen is that you have to sell the call option contract, and what are you going to do is you're going to receive a premium. Okay, now why? See, this guy's paying a premium, so you are going to receive a premium. Now, what is the opposite of right? Obligation. So you have an obligation to sell the underlying asset. Now, if you look at this, as long call, I'm buying the underlying asset, therefore you have to sell the underlying asset, and you are known as the writer of the contract. Okay, is this clear with everyone? So don't worry, we will do all the examples and all of that. But at a basic level, did you guys understand what are the rules of an option contract, of a call option contract? Okay, good.
So basically, for futures, you have margins. For options, you have no margins. It's just based on premium, right? That's the main
Exactly.
difference.
Exactly. Yes.
Okay.
Is this clear with everyone? Yes. No. All right. And guys, I'm telling you these rules, right? And we have to cover put options as well. But these rules, you need to know it in and out. Okay, you should be able to recite these rules at 2 a.m. Then only you'll understand this. Okay, all right, quickly write this down and then we'll move on to put options. Chetan, what didn't you understand? Guys, I explained the whole thing again, this thing, but you have to if you have a specific question, you need to ask, because I'm going to say the same thing again. So Chetan, where is it difficult for you? I understand short call, but what didn't you understand? What specifically didn't you understand?
So Rakshit, can I ask you something?
Sorry?
Can I go ahead, or Chetan is
Yeah,
asking something?
I don't know. He's not saying anything.
Okay,
Yeah,
okay.
you
So Rakshit,
go
it's
ahead.
like that. It, yeah, it's like that. When we are in long call,
Mm-hmm.
so we would be buying a derivative or your option, right?
Yeah,
And there would be a time that we would be selling the same thing, right?
yeah,
Then so we have to be knowing all the 8 points of both long and short.
yeah, yeah,
It's like that.
yeah, yeah,
So at a time we have when we buy a derivative contract, so we would be on, we don't have choice. We have choice to buy or not, right? But
yeah,
when we sell it, we don't have a choice.
No. Yeah. So see, these are two different option contracts. Okay, so you are not both a long call and a short call at the same time. So when you buy a call option contract, you are a buyer. That's it. But when you, let's say, want to exit your option contract, then what happens is on your system, it's called square off on your trading system. So what happens is that you will sell your contract back to the exchange. That's it. But you can be on both sides of a transaction, okay, but that's a little bit more advanced in terms of strategy, okay. But essentially when you're buying a call option, you are bullish and you're expecting the price, you have to pay a premium. But let's say the somebody who sold a call option to you, right, the person who sold it to you, they're going to receive the premium and they have the obligation to sell the underlying asset. So don't worry, we'll go through a couple examples, okay? And that should clarify it. So Chetan, I hope you understood. So when you talk about, see, it's like this. Okay, and guys, let me put it across this way, okay? You guys are, let's say, long call and I'm short call, okay? Forget about an option contract, okay? Now, why are you guys here? You're here to learn, okay? That's the first thing, okay? Now, you are sitting here because what? You paid your fees, right? You paid your fees, yes? Well, obviously, otherwise you won't be here, right? Now, is it your choice to learn or not to learn? What do you guys think? Is it your choice? Exactly. Very good, Salim. Yeah. It's your choice. Can I force you to learn? Not really. Not really. I mean, I can make your life difficult, but I really can't force you to do anything. But since you have paid, it is your choice to learn or not to learn. But do I have a choice to teach you or not to teach you? Can I say, you know what, guys, today I'm not going to teach anything, go home? Or, I mean, everybody's home only, go partying. I can't say that, right? Are you guys getting this? Yeah. Well, I don't have to teach mandatorily, Saurabh. I can always find somebody else to teach, right? But I'm joking. But you guys are getting my point, right? When you give somebody money, right? The other person is obligated to fulfill that contract. Now, for example, let's say you go to a store and you want to buy a packet of Maggie, right? You want to buy a packet of Maggie, and let's say I think it's $10 now, right? And you go and give, you pick up the Maggie and you give the $10 to the guy, but he says, you know what? You're not allowed to take that Maggie, and I don't want your money, right? Or you give him the money and he says, you know what? You cannot take that Maggie. That doesn't work, right? So see, and guys, all of this, right, is real life. You just need to um understand it from a real life perspective, and you'll get all of this very easily. Okay, so is this idea very clear about right and obligation? See, you have a choice to learn or not to
So it
learn,
is,
but I am obligated to teach you.
so,
Sorry, Piyush.
so it is always like that. Whenever the market goes bullish, we buy, and whenever the market goes bearish, we sell.
Yeah. That can see, but see, that is
Okay.
more about equity trading and all of that. See, options is a different monster altogether, and it's options is probably the one of the toughest derivatives out there. Okay, because there's a lot of things in options, and so that you don't have to worry. See, when it's bullish, you buy; bearish, you sell. That's more of an equity thought mindset. Okay, but when we talk about options, it's there's a lot of different aspects to it.
Okay, sir.
Okay. All right. Everybody done writing this?
Okay, I have one question here.
Sure.
Uh, who belongs like this underlying asset?
Mm-hmm.
Who is the owner of this asset? The person who has the obligation to sell it.
Yeah. See, for example, if you, let's say that you and I enter into an option contract, and let's say you want to buy an iPhone from me. So if I don't
Mm-hmm.
have an iPhone, can I sell it to you?
No.
No. So in a short call, right? ideally the guy would have the seller of the option would have a would own the underlying asset, but that's not necessarily true, because again in the options market, right, 95% are all speculators. 95% are all speculators.
Okay, and why you have written this call option bullish in the starting? Everything is this covered under bullish market?
Yes. So when you believe the stock price or an index is going to go up, and if you
Mm-hmm.
are long in that, or if you say you're buying
Mm-hmm.
a call option contract, you believe the price is going to go up.
No, I mean I understood both the parts separately, but why you have written this call option bullish right below that statement? Always be looked from buyer's perspective.
Huh.
I'm not understanding.
Okay. Now, why you're going to look at buyer's perspective, right? Hang on. Is see, look, what does the buyer have? They have the right. Yeah, so they have that choice,
Mm-hmm.
but the seller has an obligation. So if the buyer says, let's say you are the buyer and you say, hey, I want to buy, I have to sell. If you say I don't want to buy, then I'm not going to sell. That's the idea here. That's why we're going to look only from the buyer's perspective, because that guy has the choice, not the seller.
Okay, so we are not going to deal with the bearish
No, no,
pattern
no,
right now.
no, 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 no. Don't think about it that way. Think about, it's not that you're going to deal with it. No, no, no. What you are looking at is, what is this guy going to do? The long call, what is he going to do? Is he going to buy or not to buy? That's what you need to look at.
Okay,
If he's going to buy, then I have to sell. If you're not going to buy, then I'm not going to sell it to
okay.
you. Okay?
Yeah, fine. Thank you.
Okay. No, no. So our put options is what we're going to cover next. Okay. So long call and short call is part of call options. Okay. And guys, please don't confuse yourselves. Okay. Otherwise, it'll be very, very difficult to unconfuse you. Okay. But see, it's pretty straightforward. In call options, you have long call, short call, leave it at that. Okay. We're going to talk about put options next. Okay. But don't confuse put options with call options, because call options is different and put options is different. Yes. You have to follow a logic into it. Okay. All right. Now let's look at put options. Okay. Now, when you talk about put options, your opinion about the index or the stock is bearish. Okay, now again, what do we mean by bearish? You're expecting the price to go down, right? Now, when we look at put options, they're again subdivided into long put and short put. Okay, now when we talk about long put, again, long means to buy and you are bearish. Okay, you're bearish. And there's a short put who's going to sell you the put option contract, and that guy is going to be bullish. Now again, the idea is the same, guys, is that there has to be 50% of the market is going to be long call and 50% of the market is going to be short call. Okay, so it cannot be that it's 100 and 0 on one side. Okay, so 50% is going to be long call, long put, and 50% is going to be short put. Okay, is this idea very clear here? In put options, you're expecting the price of the underlying asset to go down. Okay, you're expecting the price of the underlying asset to go down. Okay, is this clear with everyone before I get into the rules? Yes, no?
No, actually, I have one question in this.
Yeah.
Okay, if this market is bearish, then it should have more percentage on the bearish part. How is it 50-50 both sides? That is how it will move up or down.
But the thing is, see, when the market any market is very dynamic. Okay, and if you look at, let's say, the Indian markets, right? Uh, Maybe for the
Mm-hmm.
first 1 hour the market is crashing, and for the next 4 hours the market can be going up. See, when you look at the markets, you cannot predict what's going to happen. Okay, now, and look at it this way, right? You cannot have more buyers and less sellers, and you cannot have more sellers and less buyers. Otherwise there's going to be an imbalance in the market, right? And you got to
Okay.
understand one thing is that only when I buy it, only when an option contract is bought, that means somebody has sold it. So it's not that there are millions of buyers and no
Mhm.
sellers. It's only when the order is matched on the exchange between a buyer and a seller, that is how we know it is done. But it's like saying that there are millions of people who want to buy an iPhone, but because of let's say, and based on that, what do you call it, assumption, Apple does an overproduction, and because of that, and maybe people don't end up buying it anyway, right? So you can't say that. So there has to be 50% buyers and 50% sellers. Now that 50% can be 10 million buyers and 10 million sellers. We don't know how big I mean, we won't know how big it is, but essentially it comes down to that half are going to buy and half are going to sell, and that's how the market works. Okay, you cannot
Okay, like
be a
the
situation where everybody buys and nobody sells.
yeah, right.
Okay.
Okay, that means 50% are buyer and 50% are seller.
Yeah.
But it can happen that like 70% are buying and 30% are selling. It can happen, but people are 50-50. That's what you mean.
Yeah, see, there could be 70% of the market, or let's say in that, for example, let's say if you take that 20% extra that you're talking about, maybe those deals
Mm-hmm.
are not matched on the stock exchange yet. Okay, maybe those deals are not matched on the stock exchange. So until those deals are matched, right, then again it'll come into equilibrium. Okay, it'll always come into equilibrium at the end of the day.
So I think Preeti
Okay.
wants to ask. I think I am getting what she's saying. Suppose there are three people who are there to sell, and
Mhm.
there are 10 people who are ready to buy from those three only.
Huh.
So in that way, the percentage might be different,
No, you
not
guys,
equal.
not like that, guys. See, you got to go back to financial system and understand order driven market. Now there can be 10 sellers and 3 buyers, but how will the order get matched between the buyer and seller? Yeah, you need to match the order. So if the 3 buyers quote the price that the seller wants to sell, then those 3 sellers order will get matched. And those 7 sellers, their order will not be matched until a buyer comes in. Are you guys getting the
Okay,
point?
that means for every seller there should be a buyer
Yes.
or
And
vice versa.
that's why you have to be clear
Okay.
with financial systems. For every buyer, there has to be seller and vice versa. Otherwise, it won't make sense. Then if there are, let's say, 10 million sellers and there's no buyers, the market is just going to like implode. It will not happen. Okay. So only when, so let's take your example. So there are 3 long call and 10 short call. Okay. Now the 3 buyers, if their price is matched with the seller, then the order is executed. Now let's say if there's 10 long call and 10 short call, now all their prices are mismatched, then the order will not get executed. Is this clear with everyone? Guys, think about it simply. Okay, when you go to Amazon, can you say, let's say you want to buy a phone on Amazon and it costs 15,000 rupees? Can you say no, no? You can change the price and say, you know what? I'll pay 500 rupees for that. Obviously not, right? So a transaction will only happen when the price is matched. Is this absolutely clear with everyone? I mean, it's a good question.
Yeah, it is clear.
Yeah, but you guys have to understand. See, and this is why I'm telling you guys, you have to focus on learning concept and logic. So when we talked about order, right, we said that order execution is not guaranteed. Why? Because if the price does not match, the order will not get executed. Now think about it simply. If you can you go into, let's say, an Apple showroom and say, and let's say iPhone 12 I think is coming out in the next month, and let's say it's there in the store, and they say, you know what, I'm going to give you 1 rupee for the iPhone 12, and you give it to me. What will the store people do? First of all, they think you're mad. Second, they might be very frustrated dealing with customers the whole day, so they might physically beat you up and throw you out. Right? So that's the idea, is that you have to match the price. That is the main criteria. Now if the this thing is not matched, right, then the order is not executed. As simple as that. Yeah, if your order is not matched, the money doesn't go out of your account. Okay, shall we now? Is this all clear with all of you guys? Yeah, guys, you have to study every day in order to keep up with what I'm saying. Okay, uh, okay. All right. Now let's look at put options. Okay. Now, when we look at put options, so here, hang on. Okay, everybody can see, right? My computer is doing something weird. Okay, so you're gonna buy a put option contract, and what are you going to how are you going to pay for it? You have to pay a premium. And here, now listen carefully, you have the right, the choice to sell the underlying asset, and you're known as the holder of the contract. Okay, so again, two sides of the same coin when you talk about put options. You're going to buy the contract by paying a premium, which gives you the choice to sell the underlying asset, and you're known as the holder of the contract. And when we talk about the short put guy, right? Short put, he's going to sell a put option contract. He's going to receive the premium. Why? Because this guy's paying the premium, so he will receive the premium, and he has an obligation to buy the underlying asset, and he's known as the writer of the contract. Okay, so these are, and don't worry, we will discuss each of these rules with an example. Okay, but let me be clear here. In put options, in long put, you're going to sell the underlying asset. Okay, you're going to sell the underlying asset, and the guy who's short put is going to buy it from you. Okay, so generally students get confused with put options, but don't worry, we'll work out an example
Then,
now where
Nitish, why have you written buy near long put?
sorry.
Why have you written buy near long put when it's sell?
No. See, good point. See, you're buying the derivative contract. See, options again is derivative. So you're buying the derivative contract so you can sell the underlying asset. See, this is your underlying asset here, this box. Okay. Then a put option is on top of this. Now, so this box is your underlying asset. So what you're saying is that you get the choice to sell this box to me if you want. Sell the box to me, Rakshit. That's what I mean. So you are buying the contract so that you can sell the asset to me. It's as clear with everyone. That's where I was getting to. This is the common confusion students have. Okay, and we'll work out an example. Okay, but is this idea very clear? Is that, see, put is a derivative contract, and we always look at what's happening to the underlying asset. So what's going to happen is that you are going to decide whether you want to sell the box to me or not. That's what I mean by this. Okay, so the underlying asset, whether you're going to sell it or not. Is this clear with everyone? Yes, no?
I have a question. So
Sure.
when you're saying a bearish scenario, that means, the prices have gone down.
Yeah.
So why would I buy a put option in that scenario?
Okay. I mean, actually, if you can hold on to that question, we'll come to an example, and that'll clarify it.
Okay.
Okay.
Rakshit, last thing.
Yeah.
Like buy for a derivative, buy for an option
Mhm.
and sell for an option is different thing, and buy for an underlying asset and sell for an underlying asset is a different thing, right?
No, no. See the option contract is linked to the underlying asset. Okay. So if you decide, so you buying the option contract so that either you can buy the underlying asset or sell the underlying asset. Okay, guys, actually, if you can give me, if you can just finish writing the rules down, right? We'll work out an example and you guys will understand this clearly. Okay. Hold on to these questions. And as we work through the examples, right, it'll automatically get cleared. Yeah, because what happens is the best way to understand options, right, is with an example. Okay, honestly, that's just the easiest way, and all your doubts will get clarified. Okay, now again, Bhargavi, you are no. So is put option always looked at on a seller perspective? No, you are again going to be looking at the buyer's perspective. Why? Because this guy has a choice. Okay, so guys, do me a favor, quickly write this down. Okay, quickly write down these rules. Okay, and we'll get into an example. Okay, and that's the best way. And for the example, I want all of you to have a pen in your hand when I talk about the example. Okay. Okay. All right, quickly write this down and let me know. Yes, Abbas. You are buying the derivative contract so you can sell the underlying asset. Guys, don't worry. We'll get to this is a typical confusion that students have. Okay. Give me about 10-15 minutes, right? And we'll go through each of the examples and you guys will be very clear. Okay, everyone done?
Done, sir, done.
Okay. Okay. All right. Okay. All right. Let's look at this, and guys, please have a pen in your hand. Okay, so I'm going to use a pen as an example. Okay, and then later on, we can switch it out to a financial instrument, etc. Okay. Now, the best way to understand options is through what we call as a payoff diagram. Okay, and a payoff diagram is a graphical representation of what is happening with the option contract as well as the underlying asset. Okay, so it gives you an idea of what's happening. Okay, it's a graphical representation. Okay, all right. Now, before we get into the example, there are three key terms that you guys need to know. Okay, first one is what we call as strike price. Okay, strike price. Now, what this means is that it's the price at which you enter into a contract. Okay, premium is the amount of money you pay to enter into the contract that we previously discussed, and the market price or the spot price is the current price of the underlying asset. Okay, now we'll talk about long call option contract first. Okay, now let's look at this term exercise or expiry. Okay, now exercise means, okay, let me create the example here. You are long call. Okay, all 29 of you are long call and I am short call. Okay. Now, if you want to buy the pen from me, you will exercise the option contract. If you do not want to buy the pen from me, you will expire the option contract. Is this point very clear? Okay. Now, the pen that you're holding in your hand is the underlying asset. Okay. Now, that pen is with me. So imagine, I mean, well, imagine that it's with me, right? And I'm holding on to the pen. Now you are deciding whether you want to buy the pen from me or you don't want to buy the pen from me. Okay, is this point very clear with everyone? Yes, no?
Yes.
Okay, cool. Okay, now listen very carefully. Okay, now you are long call and I'm short call. You paid 10 rupees as a premium, so rupees, dollars, pounds, euros, whatever, it doesn't matter. Okay, so you paid $10 10 rupees to me to enter into an option contract where you can buy the pen from me at 100 rupees. Okay, is this clear with everyone? So the strike price is what you and I have agreed at. So you are going to now decide whether you want to buy the pen or not to buy the pen from me. Okay. Now let's look at the first example. If in the market, okay, if in the market the price is 80 rupees and with me it is 100 rupees, where will you buy the pen? Will you buy it in the market at 80 rupees or will you buy it from me at 100 rupees?
Market.
Market. Okay. So what are you doing is that with me, okay, see, what you do outside of the contract is not my problem. Okay. So what you are telling me, hey Rakshit, you know what? I don't want to buy the pen from you, so I'm going to expire the contract with you. Okay. Why? Because you can buy it cheaper outside. Okay, now because you expired the contract, you are going to lose 10 rupees. And what is this 10 rupees? The premium that you paid. Okay, is this clear with everyone on the first case? See, again, guys, Preeti, to answer your question, right? See, this is a you have to think about the financial markets as something that is constantly changing. Every second the prices change. Okay, now for you guys to be clear with the concept, right, I have to show it as a static, like a snapshot in a particular point of time. Okay, now do you know, and see, and we don't know what's going to happen to the price in the future. Okay, but you want to enter into these contracts. Remember how we talked about forwards and futures yesterday? the logic about entering into these contracts remain the same. Okay. All right. Now let's look at the next case. Now, see, guys, this market price is constantly changing every second. Okay. Now, you're still in the contract with me. Now, the market is at 90 rupees, and with me, it's 100 rupees, and you have paid 10 rupees as premium to enter into the contract. What will you do? Will you buy it in the market at 90 rupees, or will you buy it from me at 100 rupees?
Anything will do because the rate would be same.
No, not anything will do. No, both cannot be done. See, guys, please understand, you can only do one or the other. You cannot do both. If you can do both, then the markets would collapse. Okay? So what are you going to do is you're going to expire the option contract and you're going to lose 10 rupees premium. No, Bhargavi, that's what I'm saying. You cannot do both. Okay, you cannot do both. Now, please understand this point. Okay, and I think Preeti had answered this question, right? Asked this question. See, in order to enter into the long call option contract, okay, you paid 10 rupees, $10 or whatever it is. Okay. Now, what is the value of the pen? With me, it's $100. Now, will I allow you to buy a an asset worth $100 just by paying 10 rupees? Does that make any sense? Right. No, you're not going to do that. It will not happen, right? Now, what are you basically doing is that you have to decide whether it is profitable for you to buy it from me or not. You have to decide if it's profitable for you or not. Now, in this case, is it profitable for you to buy it from me, guys? Are you guys understanding my point? It's not profitable, right? How are you making money? I mean, you can do it, but you're going to lose money, right? You're going to lose money, okay? All right. Now, this will be a heated argument, okay? What will you do when it is 100 in the market and 100 with me? Will you exercise the contract or will you expire the contract? Okay, good. Some of you are getting it. So you're going to expire the contract. Okay. So if you buy, see, if you buy it or buy it from somewhere else or whatever you want to do, you can do. But you are expiring the contract. No, Sajane, see, you've already paid the premium. That is why I'm giving you this choice. Guys, think about it this way. If somebody wants to come and learn from me, okay, or from Emarticus, can they join without paying fees? Or can you, or let's say, would you work for a company if they don't pay you?
No.
Obviously, right? No, obviously not, right? So only, so if you talk about, let's say, a job, right? They're agreeing to pay you for giving your time, energy, and effort. Now, if they're not going to pay, you are not going to do it. So you're already in the option contract with me. That is why I'm giving you the choice to exercise or expire. Okay. Now, if you don't pay me, how will I give you the choice? Okay. So here, you're going to lose your 10 rupees premium. Okay. All right. Now, let's look at this. This will maybe cause a heated debate. What do you think will happen here? Market price is 110. With me, it's 100 plus a premium of 10. Will you exercise or will you expire? And I want you guys to use the word exercise or expire. I don't want you guys to say buying in market or not, whatever. Yeah. Okay. So you can, so in this case, right, you can actually do both, but for simplicity's sake, right, I'm going to say exercise, okay, and the P&L will be 0, and this will be considered as your break even point. Okay, now see, I don't want to put this thing here because people will get confused, but some of you who mentioned expire, right, that is also correct. Okay, you can exercise or expire, it doesn't matter. Why? Because your profit is 0. Okay, but for simplicity's sake, I'm just going to say exercise. Okay, both are correct, let me say it that way, but from a non-confusing point of view, I'm going to say exercise. Okay, is this part clear with everyone? Yes, break even point means no profit, no loss. Okay, now let's look at this 120 market price, with me 100 rupees plus 10 rupees premium. What will you do? Will you exercise the option contract or will you expire the option contract? Okay, very good. You're going to exercise the option contract, and what's going to happen? You're going to make 10 rupees premium. I mean, sorry, 10 rupees profit. Okay, now how do we work that out, right? See, strike price is 100 plus premium of 10 rupees. So what is your total cost? 110. Now, what is the market price? 120, right? So what are you going to do? You're going to buy from me at a total cost of 110 and sell in the market for 120. Therefore, your profit is 10 rupees. Is this clear for everyone? Anmika, is that a yes or a why? Why it is, or it's a yes?
Yes, sir. It's
Okay.
clear.
Yeah, so you guys have to trust me. I've been doing this a very long time. I can actually do all of this in my sleep. Okay, so that's why you guys have to give me time, and you guys have to be a little patient with me, and I will hold your hand and I will walk you to the end goal. Okay. And honestly, I'll tell you, this is the best way to learn options. If you guys go, I mean, you can check online and all of that. It's quite confusing, yeah. And the options, I've been learning from like 2012, 2013. So, and I always like teaching options. It's a very interesting topic. Okay. All right, cool. Now, what are you going to do when the market price is 130 and the strike price is 100? What will you do? Now, again, you guys have to create a story in your head.
Exercise. Exercise.
Yeah, so you're gonna say, you know what? I'm gonna buy the pen from Rakshet at 100 rupees, but I paid 10 rupees premium. So my total cost will be 110. So I can buy it from him and I can sell it in the market for 130 and I'll make 20 rupees profit. Okay, so you're gonna exercise with plus 20. Okay, now let's say, can the price of the pen that you're holding in your hand hypothetically go to 500 rupees? Bhargavi, be creative. Yes, yeah. Price can go up, right? For example, have you guys heard of Mount Blanc pens? Montblanc. Those are the fancy pens. Mount Blanc, Blanc. Mount Blanc. Have you guys heard of this? It's, I think, French or Italian. I used to like collecting pens. I think a lot of you might also maybe like collecting
So
pens.
this one is French.
Sorry.
It's a French pen
Oh, it's French, huh? Okay.
company.
Mont Blanc. right? And those are like very expensive, right? So now let's say, for example, the pen that you're holding in your hand in the market. Oh, it can mix bags too. Okay, yeah, it does actually. Yeah. Um, Now let's say the price of the pen shoots up to 500 rupees. What will you do? Will you expire the contract or will you exercise the contract? Right? Obviously, you're going to exercise the option contract. Now, what does that mean? Is that you can buy the pen from me at 100 rupees and you can sell it in the market for 500 rupees. So in this case, what will be your profit? 13. Not
390.
yeah, not Sunny, not 30. It will be 390. Okay. Now I want, so when you look at this information, guys, this graph. Okay. Okay. No worries. Okay. What can you? What is a logical thing that you can infer from this? By reading this graph, I mean this table, what can you understand about a long call option contract?
It is up to buyer whether he wants to exercise or expire
Okay,
on a
good,
particular rate, whether he can decide that is it profitable or not.
perfect. What else? And there's a lot of hidden information here. I want to see if you guys can pick up that hidden information.
And so it is also a kind of a hedging which you are doing
Very good.
regarding your prices and all.
Very good. Correct. Yes, Kapil, right to buy. Also correct. There's another thing. What else? There's a hidden information there. Everything is risky, sir. No risk, no rewards. What else?
So we can check here if the market price is more, then we can always exercise the
Okay.
contract.
Okay, correct. What else?
Initially the loss, like initially we are facing the loss, then we reach the break even point, and then we reach profit levels.
Okay. What else? What else?
Sir, is the premium mandatory, like
Sorry,
for
sorry.
all the, like, is the premium mandatory
Yeah,
for
yeah.
all the like prices?
Yeah, yeah.
So
No, no, see, you're paying premium once. Okay, let me clarify, guys. See, this market price is constantly changing, okay? But you've entered into this option contract by paying a premium, and because of that, you have a choice whether you want to buy the pen from me or not to buy from me. Okay, so you're not paying 10 rupees every time. You pay 10 rupees once, but you have to decide when you want to buy it from me and when you don't want to buy it from me. Is this clear? Have you guys understood what I'm trying to say? You're paying the premium once. Now the market is constantly changing for the pen. You have to decide whether you want it or you don't want it. But okay, what else is it? There's a hidden well, there's a hidden information there, but it's right in front of you. But I want to see whether you guys can pick it up. Sorry?
Sir, buying in one market and selling in another market. Arbitrage is also happening here.
Okay, fine, good. What else? So all of you are correct. I'm not disputing that, but there's something very important there.
Buy,
So here,
buyers can decide if he wants to
Yeah, that's also
get into the
nice.
contract.
Yeah, but tell me something. See, that's everything. Anybody
So if
see?
you
Said
pay the
that.
premium, we have the option
Mm-hmm.
to buy the like.
Ah. So Sunny, that's correct. But what else, guys?
it
You're
it gives the it gives a person whether he can go into call options or put options. Like he can
Hold
then
on
go.
the contract.
no. So
Hold
don't
on
worry
the
about put
contract.
options for now. the information is like right in front of your screen. Yeah, premium is not refundable. That's okay. Come on, guys. Like the answer is right there. Think. No, Preetham, that doesn't make any sense.
The strike price and the spot price, something to do with the prices basically.
No,
So you enter into the contract. Okay.
no.
It's a long call.
Yeah, so Arshad, what are you saying?
It's bullish.
Long call. So
But
what?
the power is given to us to decide whether it is profitable for us or not.
Yeah, that's all fine. So same thing Bhargavi is saying here, right to buy all of that. No, Alok, where is the premium getting increased? Premium is the same.
After the equilibrium. After the equilibrium.
Sorry?
Maybe it is when the price of the market is going up, then we are more prone to buy it from you. Like this is what graph will mean here.
Mhm. Guys, it's like right in front of you. Okay, I'll give you guys a hint.
Even if we are having more profit, the premium is same, right?
Okay, good. What
So
else?
the
What
premium is
else?
constant for all the market price.
Sorry?
Yes. So the premium is constant for all of the market price if it's high or it's low.
Okay. Kind of getting there. Come on, guys. Should I give you the
So
answer?
even if the price comes down, we will earn.
No. How will you earn if the price comes down? Okay.
You
Why
will
don't you
get
guys
to know
do
the
this?
status of the option, whether you're in market or at the market,
No, that
kind
will
of.
come to later. I'm only asking you about the table. So don't go ahead. Okay, guys, do one thing for me.
If you pay premium, we can decide if we want to get into the contract or not.
Okay,
So
but
it's the like,
okay, hang
is
on.
that
No, not exact. That's not what I'm looking for. Okay. Okay, what I want you guys to do, okay, on your piece of paper, I want you guys to create a graph. Okay, I want you guys to create a graph. The x-axis is going to be your market price, and your y-axis is going to be P&L, profit and loss. Okay, and I want you guys to plot. I want you guys to plot the P&L,
So after
the
so
market.
after break
Okay.
even point
When the
will
market
after
price
break even point
increases,
the profit will rise.
loss comes,
Will
then
The,
we
the
will
loss
be.
is fixed.
4 5 will go.
Rakshit, the loss is constant. Like no matter what we are losing 10 premium amount. That is $10. But when it comes to the profit will increase
To how much?
to infinity, whatever the market price is.
Very good. Very good, Abbas. Very good. Very good. I'll give you a high five. Digital high five. Digital high five. Good job. That's what I was getting at, guys. Is that look at this? Yeah, I'm repeating. Okay. Good job, Abbas. Okay. In a long call option contract, your losses are limited to the premium that is paid. Okay. But your profits are unlimited, right? That's what I'm trying to make you guys understand here, right? So if we look at this, okay, so graph is here. So this is your 80, right? 90, 100, 110, 120, 130, etc. This is your profit. You guys remember all this, right? How to plot a graph. 10, 20, right? Then here's your profit line, 10, 20, 30, etc. Right? So what's happening? At 80, you're expiring the option contract. At 90, you're expiring the contract. At 100, you're expiring the contract. At 110, it is break even point. At 120, you made 10 rupees profit. At 130 you made 20 rupees profit, okay, so on and so forth. So how will the graph look like? Sorry. Okay, so I mean, looks bad, sorry, but this is how your graph will look like. Okay, so in long call, if we had to sum it up in one line, losses are limited to the premium paid and profits are
Unlimited.
unlimited, not maximum, Sunil, unlimited, theoretically. Okay, do you guys now understand what is long call option contract? Is it easy? But yeah, it's easy. I mean, the way I've explained it, it's easy, but you guys have to practice. You have to practice a lot. Then you can do this in your sleep. Like when I first joined, I didn't know much about all of this, right? So I had to sit and I practiced, and that's how I got better at it. Exactly, exactly, Sanjay. So in long call, losses are limited to the premium paid, and instead of saying gain, use the word profit. Profits are unlimited. Okay, is this clear with everyone?
Sir, I just want to ask one question.
Sure.
That when does this strike price gets disclosed or set it at 100 rupees or whatever the price is, before entering into the contract or after paying in the premium amount?
No. So it's before. Good question. See, options trade both on the exchange and in over-the-counter market. So in an exchange, you can choose which is the strike price at which you want to enter the option contract. Okay. And likewise, as
But
a
how
seller,
one?
sorry.
Yeah, sorry. Yeah,
So
yeah, go ahead, sir.
yeah, so if you decide strike price 100 and you say I want to buy at 100, okay, so the exchange will find a seller at 100.
Yeah, but if the strike price is higher than the market price,
Mhm.
then no one will go into the contract, right, sir?
Why not?
At that point of time.
See, guys, you don't know what's going to happen in the market. So price might go up, price might come down. You don't know. You're a speculator. So you might see right now you might think, okay, 100 is a good price to pay for this pen. You don't know what's going to happen. So it all depends on what is happening in the market in real time, and based on that, you can take your decisions. Is that
Okay, so before paying the premium term,
yeah?
so we get the strike price onto the screen or
Yeah,
whatever
you
the
can choose.
term is.
Yes, you
Yeah.
can choose.
Okay.
Cool. All right, is this clear with everyone? So what I want you guys to do, okay, um, write down this graph, okay, or sorry, table, okay, this table, and I want you guys to plot the graph as well neatly, not like the way I did it, okay, and essentially it should look like this, okay. Your graph should look nice and neat like this, okay. So I'll give you guys 2-3 minutes. Okay, 3 minutes I think should be enough. So write down this entire graph. Okay, write down exercise expiry PNL and plot it. Yes, options are time bound. We'll talk about it once we finish all the rest of the options. Everyone done? So all of you, your graph should look like this. Right? Done completely? Yes, no? Okay. So those who are not done, you can continue. Okay, now I'll give you guys exactly 5 minutes, okay, to figure out short call. Okay. So we're going to take the same example here. Okay. So now you're long call and I'm short call still. Okay. Now I want you guys to figure out, and I'll give you guys 5 minutes, okay, to figure out what is the payoff, the exercise, expiry, and the PNL and the payoff diagram for short call. Okay. So it's 4:02. I'm giving you till 4:07. If you've understood the concept, it will exactly take you 30 to 45 seconds. Okay, go for it. Okay, everyone done? Now, by the way you guys have said done very quickly, I have a very strong feeling that most of you got it wrong. I have a very strong feeling. Okay, no worries. Let's see. So you guys tell me. Yeah, I have a very, very strong feeling. Okay, cool. All right. So who wants to give it a shot?
I'll give. I'll
Okay,
give.
cool. So you tell me.
Yeah. We would exercise.
Okay. Okay.
Profit of 10 plus 10.
Okay.
Next one is exercise. Break even.
Okay.
Other one minus 10. Expire. Expire.
Expire. Minus
Yeah,
10.
minus 10. Expire. Minus 10.
Okay.
Expire.
Minus 10.
Minus 10.
So reverse of it will happen, sir.
Hang on.
Expire. Minus 10.
Don't be in a rush. Yeah, go ahead, Sunny.
Expire. Minus 10.
Okay. All right. So if you guys have the correct answer, keep it to yourself. Okay, let other people learn. Yeah. Okay. Now, unfortunately, Sunny, this is very, very much wrong.
Oh.
Yeah. How many of you got this answer?
Yeah.
I mean, and you know what?
Because
Good. This is good. At least you guys are thinking, right? See, I can give you the answer, but
yes,
it doesn't
short
make sense,
selling.
right? But I want you guys to learn by making mistakes. See, most of you guys in schools, colleges, and in life, you've never been told to make mistakes, right? But the only way you're going to learn anything in life is by making mistakes, right? Now, how many of you got this answer? And it's okay, it's wrong. Don't worry about it. This is the first time in your life you're doing this. How many of you got it wrong? So Chetan said you got the same thing. What about the others?
So I got it different, sir.
You got a different one?
So I
Okay.
also got a different.
Different. Okay. No break even. Okay. Yeah. Okay, cool. Different. Okay. Absolutely fine, guys. Okay, good. Please make mistakes because the more mistakes you make here, where there is no impact on money or the company and all of that, the more you're going to learn. Okay. So let's have a look at this. Okay. Now, let's go back to the rules, right? So when we talk about short call, we said that this guy has an obligation to sell the underlying asset. Now, what do we mean by the term obligation again? So let's again go up. No choice. Right? The person has no choice. So in this case, I don't have a choice. So you're long call, I am short call. Okay. Now let's look at this. Let me see if I can put both of it into one screen. Or actually, probably not.
We have to sell. Yeah, I got it.
Okay, let's see. All right. Okay, so I'm putting both of this, both the what do you call it, tables in front of you. Okay. Now let's look at this logically. You guys are long call, I am short call. Now, what are you saying as long call at 80? What are you doing?
Yeah, got it. Got it. Seller has the
Buying,
obligation
right?
to.
So if
Yeah,
you
yeah.
expire, no, you're not buying something. You bought the option contract, but what are you doing? Exercising or expiring when the market price is at 80? What are you doing? You're expiring, right? Now, if you say, Rakshat, I don't want to buy from you, can I exercise or do I also have to expire? What do you guys think? If you say expire, what should I do?
Expire, it means expire. Because whatever buyer have no obligation, seller have obligation.
Very good, Abbas. right? See,
It's
guys,
based on buyer's perspective.
exactly. So if you as long call is saying that, hey, you know what, I don't want to buy the pen from you, Rakshit, can I force you to buy the pen from me? Obviously not. So if you will expire, I will also expire. Now, what happens is that I will make that 10 rupees as the profit, the premium that you paid, right? And guys, think about it another way. All of you understand how insurance works, like vehicle insurance, life insurance, health insurance? Yes, no? Right?
Yeah,
So
yeah.
so if you want to buy an insurance policy, you have to pay a premium, right? Now, if something happens to you, then only will you use the insurance policy. If nothing happens to you, what happens to the premium? Does the premium come back to you? No.
No, sir.
No,
What
no.
happens? So that premium is profit. Yeah, no refunds. But that premium is a profit to the insurance company. Are you guys getting it? So if you, my friends,
Yes.
expire the contract with me, that 10 rupee, you're incurring that 10 rupee loss, but I'm incurring that 10 rupees profit. Yeah? Okay. Now let's look at 90. What will I do as short call?
Expire.
Yes,
Higher.
expire. Why? Because you are expiring. So if you expire, I also have to expire. Next, what are you going at 100? Can I exercise?
Exercise.
Expired.
Expire?
Expired.
Exercise.
Sure. Okay. I think now you
Yes.
guys are getting it. Plus 10. Next. Next. What are you doing? At 110, you're
We
exercising.
have to
Exercise.
I
exercise.
have to also exercise. At 120? Sorry, I think there's one. Okay. At 120, exercise. And what am I going to have? Very good.
10.
Yeah, 10 what? Profit or loss? No, Saurabh. Again, see, this exercise and expiry, right? Guys, please listen. This entire exercise expiry is dependent on the long call guy. So if you are doing this, I also have to do this. Okay? And the only thing that will change is the P&L, the profit and loss. Okay?
It
So
will be
Saurabh,
minus 10.
it's not, you're not changing. See, guys, we're not changing the perspective. So if you expire, I'm going to expire. If you exercise, I'm going to exercise. Is this clear?
Is it happening from the seller's point of view?
No, Preeti. Again, from buyer. See, you expired here. See, okay, Preeti. Let's go to an example. Okay, so you want to buy
Okay.
that pen from me. Now, market price is 80, and with me it's 110 rupees. Where will you buy?
Hmm. From market?
Okay, can I force you to buy the pen?
No.
No. So if you say, Rakshit, I don't want to buy from you, can I say, no, no, you have to buy it from me?
No.
No. So if you expire, I have to also.
Okay, then this profit of 10, how you are making this profit? This should be the buyer's profit, right?
Why?
P&L.
No, why should it be? See, you
Because
pay
we are
10
looking it
rupees
from
to
the
enter
buyer's
into the
perspective.
option contract. No. See, you paid 10 rupees to enter into the
Okay.
option contract. So even if you exercise
Mm-hmm.
or expire, that 10 rupees comes to me.
Hmm.
See, that's the example I'm giving you. When you buy an insurance policy, will they give you a premium back if you don't use your insurance policy?
No.
No. So same logic here. Why
Okay,
would I?
any which ways the profit will be yours, like the premium, it will be yours.
Yes.
Okay.
Guys, this is very clear. The idea is simple. You have the choice. If you say, I don't want to buy from Rakshit, that's fine. I cannot force you. So you expire the contract, I also have to expire the contract. If you want to buy it from me, then I cannot say no. I cannot refuse to sell it to you. So if you say exercise, I also will have to exercise. Exactly, Saurabh. So if you expire, I will also expire. If you exercise, I will exercise. Is this clear with everybody? Guys, is it very clear? This is as simple as it gets in terms of explanation. So sorry, it's minus 10 rupees as a loss. And guys, also please understand, 50% of the people make money, 50% of the people lose money. Okay? So if you make a profit, I will make a loss. If I make a profit, you are going to make a loss. It cannot be that both of us make profit or both of us make losses. Okay, at
This is a
130, what happens? Yes.
confusing because I have excess. Okay, so you are the seller and I'm the buyer,
Yeah.
and I exercise that activity.
Yeah.
Then how is it minus 10? I get 110, right? You're the seller, so you get 110. Uh, so you are losing 10 from you because the market is 120. You sold it at 110. You are
Sorry.
losing 10.
So once again, slow down. Start again. So create the story. You're long call or am I long call?
I am long call, you're short call.
Okay. Next.
So if you look at the example that you've given 100 and I pay you a premium of 10,
Yeah.
uh, I'm looking at the short call chart basically
Okay. Okay. Fine.
at 120. So 120, the market price is 120. I don't want to go with the market. So I want to buy it from you.
Yes.
So it's 110 with
Yeah.
premium. So you are losing $10. That's
Yeah.
why it's minus 10.
Yes.
Okay, makes sense. Okay.
Yes. Okay. So what Akib is saying is the right thing. It's not. I wouldn't say double entry. There. Okay. Let me use this terminology. It's called zero sum game. Okay. If I make a profit, you will make a loss. If you make a profit, I will make a loss. Okay, that's what we mean by this. Okay, so in in these three cases, right, you lost, I made money. Yes, you'll always win and lose, right? And to a certain extent, life is also a zero sum game. Sometimes I feel. Yeah. Okay, so are we clear with this? Very good, Saurabh. Exactly. So we'll come to that. So what's at 130? What's going to happen? You're going to exercise, and I'm going to lose 20 rupees. And when it's
Here
500,
losses are
you're going to exercise, and I'm going to lose minus 390. Sorry, somebody said something.
sir, here losses are unlimited.
Yeah, yeah. So then, how is the this thing? So profit is limited to the premium received, and loss is unlimited. So how will the graph look? The opposite. So almost got it straight. Ah, finally, I did a perfect, near perfect graph. I have a mouse today, so yeah. So again, this is your profit, this is your loss, this is your market price, right? Yes, right? So what does this come out to? Profit is limited to the premium received and the loss is unlimited. And if you guys remember the long call, we said loss is limited to premium paid and profit is unlimited. Okay, is this clear?
Rakshit, is there any time boundation for this?
Yeah. So we'll
Like,
come to that. That's what I mentioned. The option contracts, like futures contract, have monthly expiries. So we'll talk about that once we finish the rest of the options. Okay. So how many of you got this as an answer?
So me.
You did very good. Okay. 2 people. 3. Okay. All right. And here's the thing, guys. If you got it wrong, it's absolutely fine. Okay. Options is a difficult concept to understand. And unless you've had prior experience and all of that, then only you will kind of get it. Okay, and it's absolutely fine if you haven't gotten it, but I hope now it's clear about what is options on what is long call and short call, right? So okay, quickly write this down, right, and create a payoff diagram as well. And it's fine if you didn't get it, it's totally fine. Okay, but you guys gonna practice this. I'm gonna make you guys do some work. Yeah. Okay, so I'll give you 2-3 minutes. That should be fine. Everyone done writing? Okay, show the graph. Okay, we're good. Okay. All right. So guys, I'm going to give you some homework. Okay. First thing I want you guys to do, I mean, we're going to use the same example, okay, of the pen and the same table, and I want you guys to figure out long put and short put, okay? So it is, so again, you need to be clear with the concept, okay, of what I taught you earlier, and then only you'll be able to understand. So how I want you guys to do this, right? I mean, you don't have to do it. If you have time, you can do it on an Excel file and all of that. But very simply on your notebook, write down this table and decide exercise expiry P&L and graph, and take a photograph and send it to me. Okay. All of you have my email ID, right? Okay, so rakshit.rao@imarticus.com. Yeah. So I want you guys to figure out long put and short put. Okay. Now I will check each one and I will let you know whether you got it right or wrong. Okay. And after you have done this, okay, I want you guys to practice this at least 5 more times by yourself, but using other numbers. Okay, so you can, instead of saying, let's say market price is 80, you can just say 85, 82, strike price 97, 100, 105, etc. Okay, so any random number, but the logic will be the same. Okay. Now see, I gave you guys an example of a pen because it's something that you can relate to. Now, if we switch out the example of pen and say Apple shares, Infosys shares, okay, the logic is the same thing, right? Now, for example, let's say, hang on, let me look at a stock. I think Reliance obviously has been doing really well, right? So Reliance current market price, hang on, Reliance current market price is 2319. Okay. Now this is the current market price. Now let's say strike price is 2300. Okay. And let's say premium, sorry, 2315. No, I just saw it sort of in my phone app. It's saying 2319.75. What do you mean 231? No, I see 2319. Okay, it doesn't matter. So let's say strike price is 2,300, and let's say the premium you pay is, let's say 500 rupees or whatever it is. Okay, and you guys the same way created a table and graph, right? I want you guys to take real life examples like Reliance shares, Apple, Microsoft, Wipro, whatever under the sun. Okay, this thing. So write it. So use your own numbers and create a table and payoff diagram. So actually, instead of 10 times, I don't know whether you guys will have the time. Do it 5 times. Okay. Is this clear? So 2 bits of homework for you guys. Okay. Hang on. Sorry. Okay. So first homework. Hang on. First homework. Okay. Is going to be do payoff diagrams for long put and short put. Okay, and your second homework is take random numbers, create a table and Create table, exercise, expiry, okay, and a payoff diagram, okay. I want you guys to do that 5 times. If you can do more, good. And I want you guys to email it to me. Is this clear with everyone? Yes? See, today's your day off. I suggest you guys sit down and work on it today itself, so that tomorrow, I think most of you are working, right? So if you're working tomorrow, I suggest you guys sit down and do it, because once work starts, you'll be busy, etc., etc. Right? So are we okay with this? Okay, fine. So fine, no worries. So 2315 doesn't matter. Okay. Okay, is it clear?
And we have the assignments, right? On LMS. After this, we can do
Yeah.
the assignments related
Yes, yes. Good.
for
Yeah.
futures and options. Okay.
Yeah, so it's just a bit of work, but once you guys get the idea, right, it's pretty straightforward. So this one, if here's the thing, yesterday forwards and futures and today's options, right? So I call this as email homework. So you can email me your answers by, let's say, like Thursday or Friday of next week. Okay. So by Friday of next week, if you guys can email it to me, that's also fine. But I would like you guys to do it because it's important to understand the concept. Okay, is this clear with everyone? And you also have to finish your LMS assignment. Okay. Yeah, so if you guys are comfortable with Excel, then you can send it. If you guys are comfortable writing it down, but I would suggest at least the long put, short put, do it on pen and paper, so that you work it out logically in your mind. That's the only thing. But you can do whatever you want as long as it's done. Okay. Okay, is this fine? All right, any questions?
I was trying to learn this concept from a very long time, but today I got this.
Very good. Yeah, good. Yeah. So, and see, guys, the logic. See, I'm using pen, but you switch out pen with a financial instrument, right? And the logic is the same. Yeah. Okay, so as an update, next weekend, right? We will have your Viva for financial system, cash equity, fixed income, and money markets. Okay, so ensure that all the assignments are done for all the 4 topics. Okay, I will send a schedule to you guys either Friday evening or Saturday morning, and you guys have to use the same link and log in at that time. Okay, so your class is from 2:30 to 4:30 till 5. Yeah, derivatives is not included. We'll have another vibe with derivatives later on. So for example, I usually go alphabetical. Okay, so for example, let's say Akib will be the first one. So he's going to log in at 2:30, and I'm going to take like a 15-minute, mostly a 15-minute viva, and at 2:15 Aditya will have to log in. At 2:30 Alok, like that. Okay, so but don't all of you log in at the same time. Okay, that's just very annoying. And we split it across 2 different days. Okay, we'll split it across 2 different days, because it's a huge batch. Yeah. Yes. Okay, or I can always randomize it. So I also like messing
So
with.
it means our half of the first term is completed.
Yeah. First half of level 1 is completed. No, or else I can randomize it. Okay, but I generally do that is I put you guys in Excel, and I use a random number generator, and whoever is first
Hello.
as well. Okay.
Hello.
Yeah, Preeti, go ahead.
Yes, so actually I have my paper on 15th of September, and I will take like days or two in returning back to my hometown.
Okay.
So I'm not sure I'll try to complete the assignments before Friday, but if it is not done, I'll prefer to prepare for Viva instead of doing these assignments. So will that be fine if I'll be sending it to you next week?
Yeah, sure, no worries. But make sure you send it. That's all.
Okay. Yeah, for sure, I'll send it to you.
Sure. All right, let me stop your recording here.